When you look at the balance on your banking app, your brain automatically pictures that exact amount of cash sitting quietly in a secure metal box, waiting for you to need it. The truth is, your money almost never rests. By the time your paycheck officially lands in your account, portions of it have already been sliced up and redirected to external entities like pension funds and insurance companies. These fractions feed directly into a global financial machine that controls over $60 trillion worldwide. While your checking account earns a predictable 0.5%, your actual dollars are living a high-stakes life in the market, taking on massive risks to generate aggressive returns. Idle money is a complete myth. The cash you think is sleeping safely in your bank acts as the fuel keeping the world's most aggressive financial predators hunting. To understand where your money goes, we have to start with the aggregators. These are the foundational institutions designed to scoop up retail cash and pool it into massive war chests. Commercial banks function as money creators. They take your savings and loan out cash they don't actually have, multiplying it through the economy with a reserve rate that in many major economies today sits exactly at 0%. Mutual funds operate as giant pools for retail cash, allowing millions of ordinary investors to buy diversified baskets of stocks and bonds. Pension funds and insurance companies face a strict math problem. They collect premiums and retirement contributions, leaving them sitting on mountains of cash that must hit 6 to 7% annual returns to ensure they can pay out future claims. Because of that requirement, pension funds have become the largest single source of capital on the planet. The aggregators pool this capital for one reason. They need massive scale so they can hand your cash over to the high-risk players of the financial world to secure those mandatory returns. The apex predators are the exclusive high-risk players tasked with taking the aggregators' billions and placing massive bets. Investment banks act as Wall Street's matchmakers, orchestrating the multi-billion-dollar transfers between businesses, governments, and the funds looking to invest. Hedge funds use immense leverage, borrowing mountains of cash to supercharge their trades, to bet on everything from complex derivatives to oil prices. Managers like Jim Simons utilize heavy algorithmic trading to generate returns that routinely beat the broader market. Modern hedge fund strategy moves much faster than the traditional buy-and-hold philosophy popularized by investors like Warren Buffett. The predators prioritize speed and tolerate extreme risk. Venture capitalists take a different approach. Firms led by figures like Peter Thiel spray millions of dollars at high-risk startups, expecting 90% of their companies to fail. This relies on the power law. If a VC puts $500,000 into 100 different startups, most go to zero. But if just one of those checks goes to an early-stage Facebook, that single winner expands so massively it covers every previous loss and returns billions in profit. Private equity firms operate like corporate house flippers. They buy established businesses, strip out costs, and try to sell them a few years later for 3 to 5 times what they paid. Through a leveraged buyout, a private equity firm buys a company using mostly borrowed money, and then legally dumps that debt onto the target company's own balance sheet. If the business goes bankrupt under the weight of the interest payments, the firm walks away largely shielded from the downside. Regular working people provide the capital for these billion-dollar gambles. Every high-stakes trade made by hedge funds, VCs, and private equity is heavily underwritten by pooled savings, insurance premiums, and pension contributions. Central banks, like the Federal Reserve in the U.S., control the speed and volume of this entire life cycle from the top down. Central banks dictate the flow of capital. When the economy is sluggish, they open the taps, cutting interest rates to make borrowing incredibly cheap. This floods the system with cash, pushing businesses to take out massive loans to expand and hire. When inflation spikes, central banks slam the brakes. They jack up interest rates, starving the system of easy cash and forcing the market to cool down. They act as the ultimate architects of the system, determining how much capital the aggregators can pool and how much cheap debt the predators have at their disposal. Look back at that number on your banking app. The financial system routes your balance through a massive web of institutions that constantly create, multiply, and sometimes completely wipe out capital. This machinery efficiently pulls idle cash from savers to build skyscrapers and ensure retirees get their monthly checks. However, it is equally capable of loading legacy companies with unsustainable debt and driving them into bankruptcy. Every paycheck you deposit, Every mortgage you sign and every premium you pay acts as the active, flowing fuel keeping the global economic engine running.